All right, let's get right into it. We're going to travel back to 1975. It was a year of crisis for the economy, a real trial by fire for investors. And we're going to deconstruct Warren Buffett's shareholder letter from that year. Think of it less as a history lesson and more as a playbook for navigating tough times, a masterclass in discipline and long-term focus that's frankly just as critical today as it was back then.
So this is where our story starts. Not with some rosy forecast, but with a pretty blunt public warning from Buffett himself at the end of '74. He saw the storm clouds gathering, and he did not mince words. This really set the stage for what would become one of Berkshire Hathaway's toughest years ever. The big question was, okay, how are they going to get through this?
And here's the number, the result. For all of 1975, Berkshire's return on beginning shareholders' equity was a paltry 7.6%. Now, for anyone who follows Berkshire, that number it jumps off the page. It's shockingly low. It's the tangible proof of just how strong those headwinds really were.
In fact, Buffett would later write that his grim forecast proved to be, in his words, distressingly accurate. This was their worst performance in 8 years. So yeah, by the numbers, 1975 was a lost year. But, and this is the whole point, the lessons that were forged in that fire are what we're here to unpack.
So how did they manage it? Well, our first case study takes us inside the textile operations. You know, an old-school business that got absolutely hammered by a severe industry-wide slump.
Buffett called it a V-shaped depression, one of the sharpest and shortest anyone had ever seen. The first half of the year was just brutal. Sales completely collapsed, which forced massive production cuts and led to significant operating losses. I mean, the entire industry was in a total nosedive. And right here, this reveals the critical difference: operational discipline. See, the conventional wisdom in a downturn is to just keep the machines running, to absorb overhead, and you just hope sales come back. But what happens? You build up a mountain of costly inventory. Berkshire did the exact opposite. They had the guts to slash production to match the tiny trickle of orders coming in. And here's why that's so important. It prevented a cash-crushing inventory pileup. That meant when demand finally snapped back, they could ramp up immediately, which led to an excellent, highly profitable fourth quarter.
Okay, now let's switch gears to the insurance business. If you thought the textile business had a rough year, well, the insurance industry had its worst year in history. And you can bet Berkshire was right in the thick of it. This wasn't just a simple downturn. It was a fundamental attack on the entire business model.
And with that classic Buffett honesty, he just admits it. They weren't just a victim of the industry's problems. They actually did a bit worse. He points out that the truly disastrous results were concentrated in auto insurance and what he calls long-tail lines. Basically any policy where claims can take years and years to finally get settled.
The industry was battling a two-headed monster. And the first head was good old economic inflation. The concept's pretty simple. The cost to pay claims, we're talking car repairs, medical bills, they were just exploding. The premiums they had collected maybe months or even years earlier were based on a totally different, much lower cost world.
Now, the second head of this monster was a bit sneakier, but just as deadly, something Buffett called social inflation. This is all about shifting attitudes in society. People being more likely to sue, and juries awarding these massive settlements for things that, might not have even been a big deal years before. In effect, the insurance policies were being stretched to cover risks that were never priced in from the start. And this is just a brilliant illustration of a key risk management lesson. Berkshire's specific mix of insurance business, which had looked really attractive before because it generated so much cash to invest, was now perfectly and horribly positioned to get slammed by both kinds of inflation. What had been a major strength quickly became a profound vulnerability.
All right, so now let's shift away from all the turmoil in the operating businesses to the almost serene calm of the investment portfolio. And it's here that the contrast in mindset is just crystal clear, and it offers another incredibly powerful set of lessons.
So while the insurance side of the house was battling these unpredictable external forces, the investment approach was governed by a really simple internal scorecard. Buffett makes it plain. He could not care less about stock market fluctuations. The only thing that actually matters is how the underlying businesses are performing. For Berkshire, a volatile market isn't a threat, it's a shopping opportunity.
So how did they find those opportunities? Well, they used this timeless three-part filter. It's got nothing to do with stock charts or predicting the economy. It's about finding great businesses run by great managers and, this is the crucial part, buying them at a sensible price.
A price you'd actually be willing to pay if you were buying the whole company, not just a little piece of paper.
And here's the payoff for that incredible discipline. At the start of that awful year, 1975, the portfolio was showing a paper loss of $17 million. But by just holding on, being patient, a little over a year later, that had swung to a $15 million unrealized gain. That is a remarkable turnaround that didn't come from clever trading, but from simply owning good businesses.
And this brings us to the final and maybe the most important takeaway of all. The real lesson of 1975, well, you don't find it by looking at that one single year. You find it by zooming out and seeing it as just one chapter in a much, much longer story. Just look at this. When the current management team took over back in '65, book value per share was less than $20. By the end of this so-called lost year of 1975, it was nearly $95 a share. So despite all the volatility and the terrible operating results of that year, the long-term engine of compounding was, without a doubt, still working.
And here's the bottom line. Over that entire decade, from 1965 to 1975, Berkshire's equity per share compounded at an annual rate of just over 15%. That single bad year, it was just a blip. It was a data point, not the trend line.
And we'll end with Buffett's own definition of the ultimate goal. See, it's not about having the best year, every single year. It's about building a business that, over the long haul, can generate returns that are better than the average American company. And that lost year of 1975, with all of its brutal challenges, was simply part of the price they had to pay to achieve that objective. It really leaves us with a key question. In our own volatile times, which of these lessons in discipline, is it the operational, the analytical, or the emotional? Which one matters most?